Good afternoon, class. Once again, I am Miss Yvonne Villanueva, your instructor for Basic Accounting. Last time, we studied about the accounting cycle. So before proceeding to our next lesson for today, I want us to have a recap of the lessons we've discussed in our previous discussion. So please draw in the board the accounting cycle. Anyone? Irene. Okay, to continue the cycle, draw or list the remaining process. Zamina? Thank you. So again, this is the accounting cycle. So the steps are first,
Recording and analyzing transactions and events. Recording journals.
Next.
Posting to the ledger. Unadjusted trial balance. Adjusting entries. Adjusted trial balance. Financial statement. Closing entries. Post-closing trial balance. Reversing entries.
Reversing transactions. So, very good. Thank you. Now, in this lesson, we will learn about the double entry accounting system or the double entry bookkeeping system. So the double entry accounting system is one of the basic foundations upon which the steps in the accounting cycle and other accounting principles are based. It emerged as a result of the Industrial Revolution. Imagine, class, merchants of olden times recorded their transactions in simple lists, similar to what we call today as
Single entry method.
very good. So, through the ages, business became more and more complex. Hence, the development of more effective ways to keep track business transactions. So, the first double entry accounts was documented by Luca Pacioli, a Franciscan monk and hailed as the father of modern accounting. So under the double entry accounting system, business transactions are recorded with the premise that each transaction has a twofold effect: a value received and a value given. So to better understand the double entry accounting system or method, let us first take a look at the single entry method. So as you can see in the single entry bookkeeping, it does not explicitly record the twofold effect of transactions. So the twofold effect of transactions are what we call the value given and the value received. So separate books are maintained for the company's basic accounts such as cash, receivables, and payables. Therefore, accounting records are incomplete. So for example, consider the following transactions. Listen carefully as I read to you the problem. On October 1, 2019, Mr. Burgas invested 150,000 to start a marketing consultancy business. On October 5, the company purchased a computer for the office, 20,000 pesos. On October 8, the company rendered services and received 15,000 pesos. So under the single entry method, the company may use cash book to record its cash receipts and disbursements. So after recording the above transactions, the cash book will look like this. So, on October 1, 2019, beginning balance. Zero. And then October 1, 2019, record the investment of owner, Mr. Burgas. How much did he invest? 150,000 pesos. So, zero balance plus 150,000 is 150,000. On October 5, he purchased a computer for the office. So to record the purchase of computer, 20,000 pesos. What happens to the 20,000 pesos?
Minus.
Minus. So deduction to the 150. So we get 130,000 pesos. And then on October 8, he rendered services and received 15,000 pesos. So he received cash from customer. 15,000 pesos. Is it an addition or a deduction?
Addition.
Addition. Very good. So a total of 145,000. So as you can see, the recording of the transactions is a single entry. Do you see the difference? So we can readily determine the cash balance using this recording method. However, it will be difficult to determine the balances of other accounts such as revenues and expenses unless the company maintains separate books for them as well. So this is just the record they maintain or the book they maintain. So beginning balance, you can see the investment, the purchase of computer, the revenue or cash received from the customer from rendering services. So as the business goes along, it will be difficult to keep track of the business transaction. So an important note to consider here is that a valid set of financial statements can still be prepared even if the accounting system is incomplete. But it will require additional work to reconstruct the accounts to conform to the double entry method. Now let's go to the double entry bookkeeping. So under the double entry method, every transaction is recorded in at least 2 accounts. So once all transactions are processed into the accounting system, the balances of all accounts will be readily available. So note, all accounts have a debit and a credit side. Debit means left, and credit means right. Do you get me? So debit is on the left side and credit is on the right side. So because of the twofold effect or duality effect of transactions, the total effect on the left or the debit side will always be equal to total the effect on the right. Hence, the famous line, debit equals credit. Whatever amount in the debit side should equal the credit side. Now, here is the rule. So we have here the accounting element. Is it to increase or to decrease? In simple terms, we will list here the accounting elements, then we will determine its normal balance. So first, asset. What is the normal balance of asset? Is it to increase? To increase an asset, you have to debit. And to decrease, you have to credit. Very good. Number 2, liability. If you want to increase liability, you have to credit. And when you want to decrease liability, you have to debit. Okay, so note that asset and liability have opposite normal balance. Number 3, capital investment. if you want to increase the capital investment, you have to credit. Very good. And to decrease, you have to debit. How about capital withdrawal? So, if asset and liability have opposite effect, capital investment and capital withdrawal has also opposite effect. So, if you want to increase your capital investment, you credit it. How about if you want to increase the capital withdrawal? You debit it. And then, if you decrease the capital withdrawal, you credit. Very good. Number 5, income. How do you recognize income? It's credit. And to decrease the income, you have to debit. Number 6, expense. Expense and asset has the same effect. If you want to increase the expense, you have to debit. And decrease, credit. Now, as you can see in the board, what are the accounting elements that have the same rule as to increase and to decrease?
The liability and capital.
Liability, capital investment, and the
Capital withdrawal.
income. So they're the same, right? How about asset and expense?
The same.
It's the same also. So you have to remember it always. Okay, class? Any question? Any questions?
None.
None. Again, the rule is when you increase an asset, you
Up to them.
debit it. To decrease an asset, you credit it. Very good. How about the liability? When you have to increase the liability, you have to credit it and decrease, debit it. How about the capital investment?
To increase credit.
To increase, you credit, and if you decrease, debit. Capital withdrawal. To increase, you debit it, and to decrease, you credit it. So in the income statement, in the income is recorded when earned. So to increase, you credit it, and to decrease, debit. Expenses are recorded when incurred. So to increase, you debit, and to decrease, you
Credit.
very good. Now you know the debit and the credit side of the double entry accounting system. So class, if you are having a hard time remembering the table, you only need to familiarize yourself with the to increase part. Okay? You get me? You only have to familiarize yourself to this part, to increase. So if the asset to increase is debit, liability credit, capital investment credit, capital withdrawal debit, income credit, expense debit, it will be easier for you to remember the decrease part because the effect is opposite. Alright? Alright. So, transactions are recorded using journal entries under the double entry method. So, A journal entry is a record showing the date of transaction, the accounts debited, the accounts credited, their respective amounts, and an explanation to describe the transaction. Are you familiar with the journal entry? Now, we will now using the transactions presented earlier, a journal would look like this. So a journal or a journal entry shows the date of transaction, particulars, debit, and the credit side. So let's use again the transactions presented earlier. October 1, 2019. So Mr. Burgas invested a cash amounting to 150,000. So do you remember the normal balance of the capital investment? So he gave 150,000 and the company he is putting up receives an investment of 150,000. So a debit and a credit. Whatever the amount in the debit should equal the amount on the credit side. So what's the credit? Mr. Burgas capital. So debit cash, credit Mr. Burgas capital. And a journal entry has an explanation. So what's the explanation in recording this transaction? To record initial investment. That's all. Simple as that. On October 5, Mr. Burgas purchased computer for the office. So debit, so cash is an asset and computer is an asset. So debit computer equipment. To increase, you have to debit 20,000 pesos. And credit, cash. Right? To decrease cash, you have to credit 20,000 pesos. So he used his investment to purchase computer equipment. So it's a deduction from the capital, from his capital investment. So the transaction, the purchasing of computer, should be recorded as follows. To record purchase of computer. Any questions from the transactions, from recording transactions in a journal? So this is called journal entry, recorded in a journal. So this is what you call journal. And what is recorded in the journal? Journal entries. Alright. Next, let's go to the next transaction. On October 8th, revenue. When you have to increase revenue, you have to credit the revenue account or the income. To increase the income, you have to credit. So you receive cash. Cash debit 15,000. So to increase revenue, credit service or income, credit service income 15,000. So don't forget that the amount should equal to debit and credit, or debit equals credit. So this is to record services rendered for cash. So because the services rendered is for cash, or the customer paid in cash, you have to debit the cash received and credit the service income. So as mentioned earlier, every transaction has a twofold effect, right? Every transaction. Here is an example of a transaction. The rendering of service for cash. So the amount received is 15,000 for the amount for the services rendered, or for the services given, right? And notice that the twofold effects in the so as you notice the twofold effect in these examples. Now we have mentioned just a little bit about journal entry making, but you will learn journal entries in a depth manner in our next lesson. So now I have here examples or transactions for you to practice. So any more questions, class?
None.
All right. So to test your attention for our class for today, I would like to give you a 15-item quiz. So answer as fast as you can if you know the questions, so you can go home early. If unsure of your answer, review, read carefully, okay, are you finished? Are you all through?
Yes, miss.
Okay, now pass your papers. So next meeting, I want you to read in advance. I'll give you an assignment, a reading assignment about posting to the ledger. So read in advance, familiarize the process of this accounting cycle, and so we will have a smooth discussion for the next meeting. Thank you and goodbye.